Okay, so something pretty big just happened on Wall Street. On March 18th, 2026, the market took a serious nosedive. We saw red pretty much everywhere, and a lot of investors were left wondering what just happened. So today, we're going to unpack it all. We're going to get into exactly what went down and why. And just to give you an idea of the scale we're talking about, look at this number. The Dow Jones Industrial Average, one of the biggest market trackers, it dropped almost 769 points in a single day. Now, that's not just a little blip, That's a huge sell-off that sent a wave of anxiety through the whole system. So that's the big question, right? What was the culprit here? What spooked everybody so badly? Was it just one thing, or was it kind of a perfect storm of bad news? Well, let's piece together the clues and figure this out. All right, and that brings us to our prime suspect, the U.S. Federal Reserve. Seriously, all eyes were on the Fed's meeting on March 18th. And sure enough, what they announced ended up being the trigger for the whole day's chaos. Let's break down what they actually said. Okay, so the main headline was that the Fed decided to just hit pause. They kept interest rates right where they were. Now, that part wasn't a total shock. But, it's never just about the headline, is it? It was everything that came with that announcement that really rattled the market. So the real story was this new, much tougher outlook from the Fed. Basically, they signaled that help isn't coming as soon as people hoped. They're now only projecting a single rate cut for the whole year. They also said they think inflation is going to be higher than they thought before. And they specifically called out the conflict in the Middle East as a big risk to the economy. It's what we call a hawkish hold. Rates stay the same, but the vibe is way more pessimistic. And you can see the inflation problem right here in black and white. The Fed officially bumped up its forecast for inflation from 2.4% to 2.7%. Now, that might not sound like a massive jump, but in the world of central banking, that's a huge deal. It's them admitting that prices are just stickier than they'd like. So, the bottom line, any hopes for cheaper borrowing costs just got pushed further down the road. And here's the man himself, Fed Chair Jerome Powell, pretty much telling us there are no easy answers. This quote just oozes uncertainty. He's saying, look, we see that oil prices are going up, but we can't just ignore it if other prices don't start coming down. That is not the kind of confident message that Wall Street likes to hear. So let's move on, because the Fed wasn't making this decision in a vacuum. There were other major forces at play. You could almost call them the accomplices that backed the Fed into a corner and just added to the market's nerves. The two big ones, you guessed it, oil prices and inflation. First up, oil. Brent crude, which is the big international benchmark for oil prices, shot up past $110 a barrel. That's a huge psychological and economic number. It directly hits what you pay at the pump, what it costs to make, well, pretty much everything. It's pure fuel for those inflation fears we were just talking about. So why the sudden jump? Geopolitics, plain and simple. An attack on a massive gas field in Iran sent shockwaves through the energy markets. It wasn't just about a one-day supply issue. It was the fear of what comes next, the risk of a bigger conflict that could mess with the world's energy supply for a long, long time. And to make matters worse, we got data showing that even before this oil spike, prices were already heating up. U.S. wholesale prices were up 3.4% from a year ago. Think of this as the price tag for stuff before it even gets to the store shelf. It was another clear signal that the fight against inflation was nowhere near over. Whenever there's this much chaos in the world, like a conflict brewing in the Middle East, investors tend to run for cover. And that cover is almost always the US dollar. So we saw this classic flight to safety, where the dollar gets stronger. And while that might sound good, it can actually cause headaches for American companies that sell their products overseas. So you've got all this big picture pressure. How did it actually play out in the stock market itself? Well, it created this really interesting split. A true tale of two very different sectors, with some very clear winners and losers. And this chart really tells the whole story. On one side, you have the energy sector. It's on a tear this year, up a whopping 22%. It's basically the place to be when you're worried about inflation. But then look at the tech sector, the star of the show for the past few years. It's really cooling off, barely up, as investors start to wonder if all that spending on AI is going to pay off anytime soon. Okay, to make this even more real, let's zoom in on one specific company that got caught in the crossfire, the athletic apparel giant Lululemon. They're dealing with the broad market jitters and their own internal drama. And it's such a fascinating situation. On one hand, you've got the company's founder, Chip Wilson, publicly slamming the board, saying their moves are underwhelming. But then you look at the company's actual performance, and it's a mixed bag. They're growing like crazy overseas, but here in their home market in the Americas, sales are actually shrinking. It just shows you how a company's own problems can get way worse when the whole market is in a panic. So after a brutal day like March 18th, the big question on everyone's mind is, what now? Where do we go from here? Well, investors are now glued to their screens waiting for the next set of clues about how the economy is really doing. And they won't have to wait long. The very next day, there's a flood of data coming out. We're going to get a fresh look at the job market, the housing market, and even how manufacturing is doing. Each one of these reports is going to be picked apart for any sign of either strength or weakness. And it should come as no surprise that the experts are totally split on what's next. You've got big names like Bank of America saying, expect small gains at best. But then you have others like Goldman Sachs who are way more optimistic. The key takeaway here is the disagreement itself. It means we should probably buckle up for more bumps in the road as the market tries to find its way. And really, it all comes down to this one big question. The market is stuck between a rock and a hard place. You've got inflation that just won't go away on one side, and you have global tensions ratcheting up risk on the other. In an environment like this, figuring out where the stable ground is, well, that's the billion-dollar question that every single investor is trying to answer right now.